Have you ever felt like your money is losing value over time? Year after year, the savings in your bank account don't seem to go as far as they used to. You work hard, put money aside, but is that really bringing you closer to financial freedom? Or are you just stuck in a never-ending cycle trying to keep up? Now, imagine a different reality. Your money grows automatically, without working twice as hard. Inflation is no longer eating away at your wealth. You can retire early and live life on your terms, travel the world, pursue your passions, or simply spend more time with loved ones. This isn't just a dream, it can be your reality if you invest the right way. In this guide, I'll share 5 simple yet powerful steps to turn today's savings into a future fortune. These aren't get-rich-quick tricks, but real, proven strategies used by successful investors to build sustainable wealth over time. And here's the best part. At the end, I'll reveal a lazy investment strategy that delivers solid, long-term results with minimal effort. Even if you have zero investing experience, you can apply this method and start growing your wealth today. Keep reading to discover how you can take control of your financial future, starting now. On the right investment mindset. One of the most crucial factors in investment success isn't intelligence or the ability to predict the market. It's having the right mindset. Successful investors don't chase trends or react emotionally. They follow proven principles that build long-term wealth. Rule number 1. Only invest in what you understand. This is one of Warren Buffett's golden rules. The idea is simple. If you don't understand how an investment works, don't put your money into it. Take the 2008 financial crisis as an example. Millions of investors poured money into complex financial products like subprime mortgage-backed securities without fully understanding them. When the market crashed, they lost everything. On the other hand, those who only invested in assets they truly understood avoided disaster. Lesson learned: don't invest just because someone promises high returns. Know how it works, understand the risks, and ensure it aligns with your financial goals. Rule number 2. Think long-term, ignore short-term noise. The stock market moves in cycles. There will always be ups and downs, but over time, the general trend is upward. The biggest mistake many investors make is letting fear drive their decisions, selling at the worst possible time due to short-term panic. For example, if you had invested in the S&P 500 in 2000 and held onto it until 2023, you would have seen a 500% plus return. But if you had panicked and sold during the 2008 financial crash, you would have locked in massive losses. Successful investors don't try to predict the market. They stay invested and let time work in their favor. Rule number 3. Invest consistently, no matter the market conditions. Many people wait for the perfect time to invest, believing they can catch the market at its lowest point. But no one can time the market perfectly, and waiting often leads to missed opportunities. Instead, the smartest investors use dollar cost averaging, DCA, investing a fixed amount at regular intervals, regardless of market conditions. Why DCA works? Reduces risk. You buy more shares when prices are low and fewer when prices are high, smoothing out volatility. Eliminates emotional investing. Instead of trying to guess the market, you follow a disciplined strategy. Example: if you had invested $500 every month into the S&P 500 over the last 20 years, you would have built significant wealth, even through crashes in 2008 and 2020. Final takeaways: understand your investments before committing your money. Stay invested for the long term. Don't let short-term volatility shake you. Invest consistently over time, rather than trying to time the market. The best investors don't look for perfect timing. They focus on long-term growth and let compound interest do the heavy lifting. 2. 5 steps to build an effective investment plan. Investing is not just about putting money into an asset and waiting for profits. To achieve your financial goals, you need a clear, structured, and consistent plan. Here are 5 key steps to help. You build a sustainable and successful investment strategy. Step 1. Define your financial goals. Before you start investing, ask yourself, what do you want to achieve? Your financial goals might be buying an apartment in Paris in 10 years, achieving financial freedom before turning 50, simply saving for a secure future. Having a clear and specific goal helps you calculate exactly how much money you need and how long it will take to achieve it. Example, if you need $500,000 to buy a house in 10 years, instead of saving the entire amount, you can invest $3,000 per month with an average return of 8% per year. Thanks to compound interest, you can reach your goal much faster than just saving. Key takeaway: the clearer your goal, the more precise and effective your investment plan will be. Step 2. Choose the right investment channels. Once you know your financial goal, the next step is to choose the right investment options that match your timeline and risk tolerance. There are many investment choices, but which one is the best for you? Popular investment options: stocks and ETFs, ideal for long-term growth, with an average return of 8 to 10% per year. Real estate. In Germany, many people invest in rental properties due to low interest rates, index funds and mutual funds, great for those who don't have time to monitor the market. Example, if you invest $500 per month in an MSCI World ETF, after 20 years, your total contribution would be $120,000, but your portfolio could grow to around $300,000 thanks to compound interest. Key takeaway: choose the investment option that fits your goal and time horizon to maximize your returns. Step 3. Automate your investments to build a habit. One of the biggest reasons people fail in investing is a lack of discipline and emotional decision-making. To avoid this, you should automate your investments, making it a regular habit, just like paying your bills or saving money each month. How to do this? Set up automatic monthly purchases of stocks, ETFs, or investment funds. Don't try to time the market. Even professionals struggle to do this accurately. Use the dollar cost averaging (DCA) strategy, investing a fixed amount every month to reduce risk from market fluctuations. Key takeaway: automating your investments keeps you consistent, removes emotional decisions, and helps you maximize long-term returns. Step 4. Stay disciplined and don't panic. During market drops, the financial market is always volatile. There will be times when your portfolio loses value, but the most important thing is to stay disciplined and not panic sell. Golden rules. Market drops. Buying opportunities. When prices go down, you can buy more at a discount instead of panicking. Investing is a long-term game. Even during economic crises, history shows that markets always recover over time. Emotions are your worst enemy. The best investors are those who can control their emotions. Example: during the 2008 financial crisis, many investors panicked and sold their stocks. However, those who held onto their investments saw a strong recovery and major gains in the following years. Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." Key takeaway: when the market drops, don't panic. See it as an opportunity to buy at lower prices. Step 5. Review and adjust your portfolio regularly. An investment plan is not something you set and forget. You should review your portfolio at least once a year to ensure it still aligns with your goals. How to do this? Check your portfolio. What's performing well? What needs adjustment? If your financial goals change, adjust your strategy accordingly. Don't make changes based on emotions. Only adjust based on data and your long-term plan. Example: you invest in an MSCI World ETF, but notice that AI technology is booming. Instead of selling your entire portfolio, you can allocate a portion of your capital to this sector for diversification. Key takeaway: be flexible with your investments, but only make changes based on logic and data, not emotions. Summary: keys to successful investing. Set clear financial goals. Choose the right investment options based on risk and time. Automate your investments to stay consistent. Stay disciplined and don't panic during market downturns. Review and adjust your portfolio regularly. Investing is not gambling, it's a long-term strategy. Let time and discipline work for you. 3. Common mistakes and how to start investing now. Everyone wants to make the most profit when investing, but not everyone succeeds. Many investors make common mistakes that cost them money or prevent them from reaching their financial goals. Let's go through these mistakes in detail and learn how to avoid them. Mistake 1. Chasing hot trends. This is one of the biggest mistakes, especially for FOMO, fear of missing out investors. Real-life example, in 2021, Bitcoin skyrocketed to $60,000, creating a massive investment frenzy. Many people bought at the peak, expecting the price to go even higher. A few months later, Bitcoin crashed below $30,000, wiping out over 50% of their investment. Lesson learned: don't invest just because everyone else is. Always analyze the true value of an asset before putting your money in. Focus on investments with solid fundamentals rather than chasing the latest trend. Mistake 2. Not having an emergency fund. Before you invest, make sure you have enough money set aside for emergencies. Why is an emergency fund important? If you invest all your money without a backup fund, unexpected situations, like losing your job or a medical emergency, could force you to sell your investments at a loss. This not only cuts your potential profits, but can also put you in financial trouble. Solution: save at least 6 months' worth of living expenses in a separate savings account before investing. This ensures financial stability and prevents you from panic selling assets when unexpected expenses arise. Mistake 3. Panic selling during market drops. Financial markets go up and down. Only those who stay calm and patient succeed. Real-life example. When the market crashes, many investors panic and sell their stocks to cut losses, but history shows that those who hold on, or even buy more at lower prices, often see big gains when the market recovers. Key principles: price drops, buying opportunity. Don't see a market dip as a disaster, it's a chance to invest at a discount. Think long-term. Don't let emotions dictate your decisions. If you believe in an asset's value, stick with it. History proves it. Every past financial crisis has been followed by recovery and growth. Lesson learned: stay patient and disciplined. If you have extra cash, buy more during downturns to maximize long-term returns. Final thoughts: take action now. Now that you know the key principles of smart investing and the mistakes to avoid, it's time to take action. Here's what you should do today. Set your financial goals. Are you investing for a house, early retirement, or passive income? Choose the right investment: stocks, ETFs, real estate, or investment funds. Start small. Don't wait until you have a lot of money. Start now and take advantage of compound interest. Comment below: what will you invest in first? If you found this helpful, share it with your friends so we can all build a strong financial future together. Your financial success starts with the decisions you make today. See you in the next episode.